Once again, good morning, everybody. My name is Brett Vargo. Let's see, I've been here for about 2.5 weeks now. I am the Marketing and Systems Support Manager. So for those of you that I have not yet interfaced with, I look forward to it. And, of course, I'm here for you, so let me know what's needed. I know we've all been on plenty of webinars and conference calls lately with the VA rollout, the lender's office rollout, the doc magic. So, I appreciate you just being here and having your attention. So, thank you for that. I also recognize that everybody on this call is probably going to be at a different place in your VA expertise and experience. There's probably some of you on this call that have never touched a VA loan before and, maybe don't even know how to spell VA. And then there's probably others that are seasoned pros. So, this is really an overview. Hopefully everybody will take something away from it. I've tried to keep it broad enough so that it's a good kind of newbie, introduction to the product, and then, get into some kind of microscopic details as a refresher for those that have done it before. So I do have to stress the keyword overview. It's not a substitution for your VA lender's handbook, your investor guidelines, or any of that good stuff. But I will send you at the end of this presentation not only a copy of my presentation, but I will also send you our investor guidelines, and we currently have 2 investors on board for VA, Plaza and US Bank, and then I'll send you over some other goodies as well to get you on your way. We're also in the process right now of creating our marketing/training channel. We're going to have some video training, so this is actually being recorded right now. I might have to chop this intro off, but anyway, so we're going to post this on a website where you can actually go in and view this training again at a later date. So without further ado, let's get going. All right, first of all, just a little overview of what the VA program is, and I know everybody's very astute, and you probably know that the VA is, well, either the Veterans Administration or the Department of Veterans Affairs. And really the program came into being when President Roosevelt signed the GI Bill during World War II. Basically, this portion of the bill served 2 purposes. It was to, 1, stimulate the housing market and stimulate jobs within the housing industry, but also provided valuable housing assistance to veterans and their families. It's a federally guaranteed mortgage, so currently guarantee up to 25%, and because of that mitigation of risk, there is no down payment, or can be no down payment, to the veteran. It's just kind of a then and now scenario. At the time, back in 1944, maximum loan was $2,000, and they guaranteed 50% of that. So the times, they have changed. Roll over some basic benefits of VA. As we discussed, there's no down payment required, and that's up to the county limit. Like our FHA and our conventional high balance, they do go above and beyond standard conforming limits based on county. Now, also, like conventional and FHA, those limits are set to expire at the end of September. So VA has not yet come up with their new loan limit chart, but that will change. But I have included a link in this presentation, and you'll see it pop up several times throughout the course of the presentation that you can just click on and view the county limits. There's no monthly MI, unlike your standard high LTV conventional financing or FHA, and that helps the veteran to qualify for a larger loan. We're going to talk a little bit about seller contributions today. And the neat thing about the program is that they will allow seller contributions up to 4% of the value. But they don't include standard normal closing costs in that percentage. So the seller can pay for standard closing costs as well as give an additional concession above and beyond that. The VA is very protective of veterans. Many fees actually cannot be paid by the veteran. You probably heard the term VA non-allowable, so we'll go over those as well. For any funds that do need to come into the closing table, they can be 100% gifted. VA will allow a 90% LTV cash out refi. We're going to talk a little bit about refis. VA actually doesn't offer a rate and term refi. It's either a streamline or what they call a regular refi, which can be cash out even if they're not taking cash. There's no minimum reserve requirements in most cases. They're going to be more flexible and forgiving on adverse credit. In fact, if a veteran gets into problems, have trouble making their house payment, the VA will offer assistance and counseling to that veteran. They can use their entitlement multiple times. We're going to talk about, their entitlement and eligibility. They can replenish that over the course of their lives and, use it many times as they purchase and dispose of property. It is an assumable loan, and that, of course, is as approved by the VA and the servicer. Generally, a veteran is going to qualify for benefits after 2 years of service. There's a chart. I included a link towards the end of the presentation, but there's a chart based on, whether they served during wartime or peacetime, what year they enlisted. So it may vary from there, but just the general guideline is 2 years if they served after 1980. The exception being if they were 90 days active duty during the Persian Gulf era, which is basically defined as 1990 to current time. And then reservists are also eligible for VA financing, generally after 6 years, or again if they were called into active duty for 90 days during the Gulf crisis. Also, unmarried surviving spouses are eligible for VA financing if their spouse died in service or from a service-related disability. Oh, yeah. Okay. Yeah. And again, everybody will get a copy of this presentation as well. Next slide, down payment and loan amount. So we talked a little bit about the VA guaranteeing 25% of the loan, and that is up to the county limit. So because there's less risk to the lender, we can do the loan without a down payment as long as they are at or below the county limit. Once we get above the county limit, that doesn't necessarily mean that we can't do the loan. However, it means that the borrower is going to have to make a down payment of some sort. And the simple calculation is that they need to make a down payment in the amount of 25% of the difference between the sales price and the county limit. Huh? All right, well, we're going to go over this example. In the blue box down at the bottom here, we're looking at the county limit currently for San Diego County, which is $537,500, and our example sales price is $700,000. So, okay, easy enough, math whizzes. We're going to calculate the difference by taking the sales price minus our county limit. We come up with $162,500 difference. We are going to take that difference, multiply it by 25%, so that's $40,625, and that is the amount that the veteran will have to put down on the home. Take our $700,000 sales price, less our down payment, still takes us to a $659,375 max VA loan. And in this example here, that's still a 94% LTV, so pretty awesome. I mean, that's something you're not going to get with your standard high balance financing. All right, well, we talked about there being no monthly mortgage insurance on a VA loan. However, there is something called the VA funding fee, and I guess the closest analogy would be like the upfront MIP on an FHA loan. It's a fee that the borrower has to pay up front, can be financed into the loan. Nice thing about a VA is in most cases it can be financed into the loan above and beyond 100% of the sales price. So for example, borrower does a $300,000 loan, $300,000 sales price, they can add that VA funding fee to that total loan amount. So it can be paid in cash, financed into the loan, or they can do a combination of both. There are certain instances where the VA funding fee may be waived. We're going to get a form called the Verification of VA Benefit-Related Indebtedness, love those long form names, or the 8937, and that's going to give us VA's final determination as far as whether they're exempt from the funding fee. And we're looking at borrowers that are disabled and receiving VA compensation, that would be eligible to receive compensation if they weren't receiving retirement pay, surviving spouses, if their spouse was in service and died because of a disability or while in service, they're exempt as well. But VA will make the final determination of that exemption on that 8937 form. So we have the chart here. You can see that the chart is tiered based on how much money they're putting down into the transaction, whether they are using their VA entitlement for the first time or whether they are a repeat user, and then whether they're regular military or reservist. And then there's also separate tiers for doing a regular / cash out refi or an IRRRL, aka a streamline, that we'll talk about later. So let's just look at a quick example here. So let's take a $400,000 deal. Let's just say that they have no down payment, so 0% down. They're a first-time user, regular military, so we're looking at 2.15%. So we're just going to take that loan amount, multiply it by 2.15%, and that's going to give us our VA funding fee amount of $8,600. So like I said, they can take that VA funding fee and roll it into the loan above and beyond the purchase price. So that's going to take our total loan amount in this example to $408,600 for a 102.15 LTV. Allowable fees and concessions. So again, there are certain fees that the borrower may pay for, and certain fees that the VA absolutely says is a big no-no. The vet cannot pay for them. As far as what they can pay for, this chart over here, they can pay up to 1% origination. And you're going to see this in all VA guidelines, in the investor guidelines, etc. But I do want to clarify that that doesn't really apply to us. The reason being is, we're talking about borrower-paid fees versus, you as an originator getting your compensation from the pricing. So, since we at iServe only allow compensation coming from that one avenue, there is not going to be a quote-unquote origination point charged to the borrower. So when you see that in the guidelines, just keep in mind that that doesn't really apply to us. They can pay for bona fide discount points, so the actual amount paid to buy down a rate. They can pay for a credit report or an AUS-DULP evaluation fee that includes credit. They can pay hazard, flood, appraisal in most cases, title, recording, and then prepaid such as impound. Now keep in mind that all fees may be paid for by the seller. They are allowable for the borrower to pay, doesn't necessarily mean that they have to. As far as the non-allowables, it's pretty much anything else. Now we're talking about any additional appraisals. If we want to get a field review or desk review on the property, then the borrower can't pay for that. If the appraisal was requested by somebody other than the veteran or us as the originating lender, any escrow, attorney, tax service, etc., Any brokerage or lender fees, our fees, cannot be paid for by the veteran. So in the case of a purchase, typically that's going to be picked up by the seller. In the case of a refi, it's typically going to be covered by us. And then in addition to just those standard, normal, run-of-the-mill, customary closing costs, the seller can contribute up to 4% of the sales price. So above and beyond standard closing costs. So that can include payment of the VA funding fee, so they don't have to roll it into the loan. Prepayment of taxes and insurance. If there's any gifts that are using as an incentive to purchase, TV, microwave, Cop Rock DVDs, whatever. Temporary interest rate buy down. They can even go as far as paying off delinquent credit items or judgments on behalf of the borrower. So I mean, they're pretty lenient. Thing to keep in mind, the VA, again, is always keeping the veteran's interest in mind. So they're very flexible as far as what can be paid for on behalf of these veterans. All right. Mentioned that we have 2 investors currently lined up. Don't worry, there will be more, but right now we have Plaza and U.S. Bank. So I just put together this kind of snapshot overview of the differences between the investors and what they will allow. Now, of course, both investors will be, by the time we go live, they will be in Price My Loan /iPrice, so you will be able to run those through the eligibility engine and figure out what loan is eligible for which investor and see the pricing for both. But just to highlight a few of the differences here, if we look at Plaza, you'll see that up to 417, 1 to 4 units, they will of course go to 100% LTV. They will go down to a 620 credit score, and then I'll point out the DTI and kind of explain that a little bit more. Plaza will go to a 50% DTI on a manual underwrite. And I have to say that, I mean, of course, the first line of attack is to run a loan through AU. But you might find that there's going to be several instances where you have to do a manual underwrite on a VA. For example, and I may be jumping a little bit ahead of myself because we're going to talk about credit items a few slides up, but the seasoning on a prior bankruptcy on VA is 2 years. Chances are you're probably not going to get a DU approval if they're just 2 years on a BK. But as long as that's the only reason for the refer through DU, our investors will allow the loan to be underwritten manually. Standard manual DTI guidelines through the VA are 29 on the front end, 41 on the back end. So if you exceed that, we're going to want to see some compensating factors. And then Plaza will go to 60%, for example, with an AU approval. Keep in mind that also needs compensating factors. So you can just look at these charts and kind of see where the breakdown is based on our loan size. So once you hit 417, they're going to want to see a 720. You're not going to be able to exceed your 41 standard manual ratio or 45 AU, etc. So on the other hand, looking at U.S. Bank, they're starting at 640. They're capping out at 41 on any manual underwrite. And with AU, as long as we have that approval and compensating factors, they haven't really set any clearly defined DTI limitations. Chances are you're probably not going to get a DU approval, above that 60 mark anyway, if even that. You'll also notice that U.S. Bank then shaves your LTV for the number of units. 2 units up to 90, 3 to 4 units up to 80. So just be cognizant of the differences between the investors and know the limitations. You'll also notice that as you go up in loan size, U.S. Bank's credit score requirements all of a sudden become more lenient at 660 than Plaza's at 720 and 740. So just keep all these little moving pieces in mind. Also, just a slight difference on our loan amounts. Plaza, they're going just a little bit above $1 million, almost to 1.1, and U.S. Bank caps out at 1. There are some Plaza investor-specific programs where they have to, market towards GMAC or Wells, or I think those are really the two major ones, where there may be additional restrictions. So again, this is an overview, but always defer to investor guidelines. All right, as if I haven't filled your heads with enough stuff, we're going to dive into some underwriting basics. I'll just go over some very general credit guidelines. As far as adverse credit on a BK, already touched upon this, but it's generally 2 years coming off of a Chapter 7 BK before a veteran is eligible for VA financing. Now, I say generally, and you're going to hear me use that word a lot, because there are exceptions, as well as there's also that big looming beast called underwriter discretion that comes into play. So generally it's 2 years. VA will actually allow, under extenuating circumstances, let's say death of a major wage earner, for example, they will possibly allow between 1 and 2 years off the VK. That is a very rare exception. Anything less than 1 year, there's no chance. The Chapter 13 BK, like FHA guidelines, as long as they have satisfied their Chapter 13, they're okay to do the loan. They can possibly do it if they're in their payout period and they have 12 months of successful satisfactory payments, as long as they get a court approval. The judge is authorizing that they are okay to enter into the transaction. The exception on BKs, if you go above 417, can't have a BK within the last 7 years. Foreclosures kind of follow the same rules, generally 2 years. I would say extenuating circumstances probably even rarer on a foreclosure. The key also, and I know we haven't really talked too much about entitlement yet, but it's important that you ensure after a foreclosure that the borrower has had their full entitlement restored. And as we'll talk about later, doesn't necessarily mean they can't do the loan, but they're going to have to put a down payment down to offset that risk. And then, I think this is pretty standard in any foreclosure situation. Definitely have to develop the story and the information, behind the foreclosure. As far as other adverse credit items are concerned, collection accounts, I'm going to use that bad word generally again because, there's a lot of underwriter discretion that comes into, looking at the overall credit profile and determining whether collections should be paid. So I will just say generally, per VA guidelines, if there's an aggregate balance of $1,000 or less, usually that can, remain open. If it's medical, those can generally remain open as well. Judgments, they have to be paid. No doubt about it. Remember, on a purchase, if the seller's, kind enough to pony up and, pay off a judgment, they have that option, but they must be paid in full at or prior to closing. Other thing I want to mention on credit, in a community property state, if there's a non-purchasing spouse, we have to pull the spouse's credit, and we have to consider the debts in the DTI. Same as on FHA. All right, let's move over to assets. As far as cash to close, it's quite possible that a borrower could do a VA loan without having to bring in any money to the closing table. But if they do, we have to have sufficient funds to verify any closing costs that they're responsible for, and then any down payments that they may be coming in with. If there is a difference between the appraised value and the sales price, then they'll have to come in with that difference as well. On cash reserves, as long as the loan's below 417, there's no cash reserves required. Once you get above that, then our investors are going to start wanting to see some money in the bank. I pulled Plaza's guidelines for the next two bullet points. If they are between 417 and 650, they're looking for 6 months PITI, and then anything above 650, they're looking for 12 months PITI. But just your standard up to 417, nothing is required. Self-employed borrowers, if they're using business funds, those can typically be used for a down payment only if they're a sole proprietor. If it's a partnership or corporation, cannot be used for the down. All business types can be used for closing costs and reserves. That is kind of this, again, probably standard across, all programs when you're using business funds. But we need to make sure that the borrower pulling those funds out of their business is not going to adversely impact the business. And we're going to want to really analyze the business's strength and stability. All right, on income, we want to verify a minimum of 2 years of employment. That includes previous jobs. We have to put together that history. Had a couple good questions on the last call as far as a borrower retiring from the military or being honorably discharged or whatever, and they go into civilian work. And that's fine as long as they already have that job lined up, they already have a stable source of income, and it's just like straight salary. It's easy income to calculate. If they get out of the military, 2 months have elapsed and they're 1099 or self-employed, yeah, it's going to be tough. We're going to have a 2-year history of that income. Only verified income can be considered. If they're active military, we want to make sure that they have at least 1 year of service remaining, because we want to know that that source of income is going to continue into the future. If we have a spouse on the loan, we're going to want to verify his or her income as well. I'm sorry. Not trying to be sexist. His or her income. Acceptable income documentation, standard stuff, pay stubs, their military leave and earning statement, VOE, W-2s. If they have any overtime, part-time, second job, we really need to have it for 2 years in order to be considered reliable income as far as qualifying is concerned. If the borrower is receiving any child support, alimony, separate maintenance, has to be disclosed. We have to verify continuance of that. If they're receiving any income from public assistance, Social Security, etc., we want to make sure that it continues for a minimum of 3 years. If they are in the reserves or National Guard, we can include that income as long as we have a substantial history that gives us reason to believe that that income will continue going into the future. If we don't have that comfort level, you can still use that to offset obligations that are, let's say, installment debts that are between 10 and 24 months remaining in duration. And then if there is any sort of temporary income, VA educational allowances, unemployment, anything like that, we cannot use that. Even though like an education benefit may show up as pay, for example, it's really not. I mean, it's to be used for education purposes. And there's certain restrictions for continuing to receive that income. All right, moving on. If the borrower currently owns their primary residence, they're going to purchase a new one, convert that to a rental. It's going to sound kind of familiar because it more or less follows the same guidelines as FHA. Generally, we're going to have to hit them with both payments. We can't use rental income as an offset to the mortgage payment. And then we're going to want to see reserves equal to 6 months PITI for both their existing primary and the new subject. Now, there are exceptions. where kind of follows FHA guidelines as well. We can allow the borrower to qualify using 75% of the gross rent, and I underline this part here, to offset the mortgage payment, meaning we can't give them positive rental income. We can just use it as an offset to that payment. And that is eligible if they are relocating, and it's got to make sense. It has to be a distance from their current primary where it's unreasonable for them to commute. So that can be whether they are taking a new job or I'm sorry, whether they're with a new employer or they're being transferred from their current employer. The other exception is if they have equity in the property that they're vacating, at least 70%, or 30% equity, LTV is 70% or less. And we're going to want to see an appraisal on that property, no more than 6 months old, or in lieu of an appraisal, we can take the current unpaid principal versus the original sales price. Now, in both cases, either the relo or the equity, we're going to want to make sure that they have a renter lined up. So we're going to want to see a minimum 1-year lease and then evidence of the security deposit and or the first month's rent. Now, keep in mind that this is just for conversion of their current primary residence. If they have any existing rental properties and they show up on the Schedule E, we can use that and give them the appropriate income. Oh, I should mention before we go on, too, that you'll see the question box probably in the upper right-hand corner of your screen. If you have any questions throughout the presentation, I know everybody's on mute right now, but please go ahead and ask away, and at the end of the webinar, we will answer those questions as best as we can, and anything that we can't, then we will get back to you on those. All right, moving on to liabilities. One thing that I thought was pretty cool when I was going through Plaza and U.S. Bank guides is that they will allow the borrower to qualify at the note rate on any of their products. So they offer a fixed, a 3-1, or a 5-1. I think it's pretty rare nowadays that you'll find a 3-1 program where you can qualify at the note rate. So keep that in mind. Any installment debt, have to include that in the DTI if there's more than 10 months remaining. Or if there's less than 10 months remaining and it's going to severely hamper the veteran's finances during the beginning months of the loan. For example, if we have a BMW loan of $750 a month and we have 8 months remaining, well, that's a pretty big debt. I mean, if they're pushing ratios, chances are we're probably not going to do it. If they have an auto lease, regardless of the number of months, have to include it in the DTI. Any alimony, child support, or maintenance being paid out by the veteran or spouse has to be included if more than 10 months remain. If we have any revolving debt, VA will actually allow revolving debt to be paid off, but we have to include something. So I mean, we're typically going to take the monthly payment per the credit report. If we can't determine the amount of the payment, then we're going to use 5% of the outstanding balance. If there's deferred student loans, if it's deferred over 12 months and we have proof of that, we can exclude that from the DTI. This is another one that was kind of new to me. 401k loans or any other loan that's secured by a depository account don't have to include it in the DTI. That was kind of a cool little feature. So paying off debt, we kind of talked about this. Installment debt, they can pay that off to qualify. Revolving debt, they can pay off. We need to at least count a minimum $12, where did I get that? $10 payment in the DTI. Co-signed obligations. If they are a co-signer on another loan and we can get proof, and we're typically talking about 12-month canceled checks that another party is paying for it, and we have no reason to believe that the borrower will be, it will be necessary for them to participate in that repayment, we can exclude that. I did a loan, or I had a loan come in at my last company that I just want to kind of make the distinction here. Here's a situation where we would not be able to exclude the debt. Let's say the borrower is the sole note holder for a piece of property, and their brother or kids or whomever lives in that property and makes the payment on their behalf. Now, that doesn't fly, because still our borrower is responsible for that payment. Payment shock. This is kind of a tricky one because it's another one of those underwriter discretionary things. VA doesn't have set payment shock limitations, but it's either going to be one of two things. It's either going to be a major detractor when the underwriter is evaluating the overall file, or it's going to be a heck of a good compensating factor if the payment shock is low. Speaking of which, all right, I'm going to go over VA's recommended compensating factors. And I will tell you right off the bat that this comes directly from the VA. Some of these things on here, quite honestly, are things that an underwriter is going to expect, not necessarily a compensating factor. For example, excellent credit history. Well, we hope the borrower has excellent credit history. So, I mean, there's going to be some things that are still underwriter discretionary type things. Conservative use of consumer debt or minimal use, long-term employment, assets, if they're putting more down or they have equity on a refi, little or no payment shock, again, is a big one. We're going to talk about residual income on the next slide, but that's the amount that's left over for family support after all their debts are paid. That's a huge compensating factor, and in some cases is necessary. If they have a low DTI, and then the overall tax benefit of home ownership. Now, VA does specify that compensating factors are great for justifying an expanded DTI. However, it cannot be used to offset unsatisfactory credit items. So you can't have, you can't overlook a judgment, let's say, for example, because they have some money in the bank. In fact, that's all the more reason for them to pay it off. All right, so we touched upon residual income. So what the heck is that? So again, the basic definition is it's the amount of net income that's left over to cover the family's living expenses after all the debts are paid. So we're talking about food, health care, clothing, those sorts of things. I included the VA chart down here. Now, this isn't necessarily a requirement, but this is a guideline. They're going to include all family members within the household in the family size, with the exception of a non-borrowing spouse that makes enough to basically survive on his or her own, or if there's a child for whom they're receiving foster care or child support payments. Then you can exclude them from the family side. So it's very simple. I can send you guys, I didn't include this, but I can send you over the region list if need be. But you have your loan amounts, either south of 80,000 or above 80,000, your family size, and then the region. So I'm going to take, for example, a $150,000 loan in the West, a family of 4. The guideline for the amount that family should have remaining is $1,117. Now, this is a great compensating factor if we're going to be, pushing ratios, let's say. Not necessarily a requirement. If they don't meet that residual income, it's not necessarily going to be a reason to decline the loan in and of itself. Now, not meeting residual income along with other risk factors, absolutely. That could lead to an adverse decision. The other thing I wanted to mention is that actually in some cases, let's say, for example, a manual underwrite over 41% DTI, it's going to take an act of Congress if they don't meet the residual income limitation. or requirements. So, yeah, so keep that in mind, especially on those manual underwrites. I mean, we need all the strength we can get. Now, this chart can be reduced by 5%, or in some cases even more, and that's all depending on the regional loan center, if the borrower is active duty. And the reason being is because they're close to the military base, and he or she and his or her family is going to be able to take use the benefits of that nearby facility. All right, we're going to move on to the first of the VA forms that kind of looks a little different here. We're going to look at the loan analysis form, or the 6393. The equivalent to a conventional loan is the 1008, and an FHA is the 92900 LT. It's basically where the underwriter is going to work out all the calculations. So just over here on the left, this is the full form. I know you can't see it, but that's what it looks like. And then we're going to blow up a couple sections here. So this top section, Section A, is just basic loan data, borrower, loan amount, age, occupation, so just pretty standard stuff. Here's where we get into the nuts and bolts. Sections C, D, and E. Section C is for their estimated housing expenses. Now this is a little bit quirky when you compare it against the 1008. So first of all, box 14, term of the loan, easy enough. Box 15, the P&I at X interest rate. In this example, 4 1/4. So we're looking at, I think I said our loan amount at $200,000. So we have a 983.88 P&I. You have your taxes in box 16, insurance in 17, 18, any sort of special assessments that may apply. Now here's the first of the quirky boxes, box 19, maintenance and utilities. Again, remember the VA is trying to ascertain how much the borrower has remaining after all expenses. So they're going to want an estimate of maintenance and utility costs for the property. And it's actually a really simple calculation. They just take the square footage and then times 14 cents per square foot. So in this example, I came up with $210 monthly. So we're not going to include this in their DTI, but we are going to take it into account when we figure out our residual income. And then in box 20, you have your other fees. $100 we'll just say for HOA, which brings us to our total housing of $1,488.88. Section D, you have your debts. This example borrower has a secured card for Bank of Hovind at $100 a month, and then they got that sweet Yugo, and they're paying $35 a month for it. So they have additional debts of $135. All right, now Section E is where we're going to figure out our DTI and our residual income. So line 31, gross salary, yeah, pretty standard. Spouse there, borrower there. So in our example, we have $4,000 in gross salary for the borrower. This yellow shaded box here, these are the deductions from their payroll. So this is going to take into account, again, this is different than any other loan type that we work with, their federal and state income tax deductions, their retirement or Social Security, what they put into those accounts, and then anything else that may apply that's taken out of their paycheck. So in this case, we have a total, you can see on line 36, of $500 in deduction. So again, those aren't going to affect our DTI in any way. It's only going to affect our residual income. So you see the net take-home pay in box 37 is simply our income minus our deductions. So in this example, $3,500. If there's any pension or other income that would apply, that would go in line 38. And then line 39 is basically just going to be their take-home plus any other income. Now in line 40, we are going to, oops, got ahead of myself. Line 40, we are going to subtract out any debts that we're hitting them with in Section D. So in this case, that $135 carries down. And we come up with their total net effective income at $33.65. So as you can see, we're taking this total in line 39, subtracting out our other obligations to come up with our net effective income. Now we're going to take on line 42 our shelter expense that's carried over from our total on Section C, and we're going to subtract that from our net effective income. That is going to give us our residual. So you see this box that I have shaded right now is the figure from the table we looked at before based on family size, where they're located, loan amount. So $967 in this example. And then this is the actual residual. So we more than handsomely meet that guideline. Not too bad, huh? And then line 44 is going to be our true DTI ratio calculation. And, you know, it spells it out right here for you exactly what's going into that calculation, but it's no different than any other loan once we get to this point. So it's basically your housing payment excluding this maintenance and utilities divided by the income excluding the deductions. So in this case, we have a 35% DTI. All right, let's move on to Earls. My name is Earl, otherwise known as the VA Streamline. Basically, so I'll throw this term at you. Earl stands for Interest Rate Reduction Refinance Loan. And it's basically a refi of an existing VA loan. In this case, like any Streamline, there has to be a tangible benefit to the borrower. In the VA's case, they want to see that both the rate and the P&I are reduced, with the exception of a loan that's refinancing from an ARM into a more stable fixed rate, or if the term is decreasing, like say for an example, going from a 30-year to a 15-year. The loan amount can include our unpaid principal balance, prepaid. You may or may not remember looking at the VA funding fee chart and noticing that for Streamlines, the funding fee was only 0.5%. So that may be included as well. Allowable closing costs, costs that the borrower can pay for, and then a max of 2 discount points. And took our 2 investors once again, gave you a little snapshot of what they will allow on Earls. Max LTV, want to make this distinction for Plaza. They're going to max out the LTV at 100% of the appraised value, including that 0.5 point VA funding fee. U.S. Bank, on the other hand, will allow 100% plus the VA funding fee on the Streamline. You can go over and above 100% LTV. Credit scores, Plaza starts out a little more leniently below 417 at 640, and then jumps up to 720 and 740 as you go up in loan size. U.S. Bank starts a little bit stricter at 660, but then they are more flexible with their credit scores as your loans get bigger. In all cases, no lates in the last 12 months on their mortgage history. Max DTI, 41% is the general guideline. And then they will allow up to 50 with compensating factors with Plaza. U.S. Bank, I found they like to leave their guidelines a little bit more vague. And they don't specify a max DTI, but will entertain a DTI in excess of 41 with compensating factors. All right, the all-important $64 question. Is there an appraisal required? In most cases, yes. Now, when you look through VA guidelines, you're going to see in there that on a Streamline, an appraisal is not required. That is true. An appraisal is not a VA guideline on a streamline. It's an investor guideline. We want to make sure that the collateral is sufficient. They haven't lost a ton of money on the property. So for that reason, in most cases, we are going to want to see a conventional appraisal that follows AIR standards. So it's ordered through our normal AMC channels. The reason why we want a conventional appraisal is we don't want to have a VA appraisal in that file. It is not going to go to the VA when we send that insuring package. It's really for our and our investors' comfort level. There are a couple of exceptions through Plaza where you can do it without an appraisal if the loan is currently serviced by GMAC or Wells. Keep in mind that if that's the case, then they are going to have to move it to an investor-specific program, and additional restrictions or pricing hits may apply. All right, we talked about the possibility of reducing term, let's say from a 30 to a 15-year, where the PITI may actually increase a little bit. If it does, and it increases by more than 20%, then we need to basically credit qualify the borrower, show that they have the ability to repay. So in that case, we're going to have to get income documentation, pay stubs, W-2s, verbal DOE. Who can go on a IRRRL loan? Well, generally it's whoever was on the previous VA loan, they should remain on the new loan. You're probably gathering by now that, like most things, there are exceptions to the rule. And the chart below here itemizes some of those exceptions. The exceptions are highlighted in yellow. So for example, if on the existing VA loan we had an unmarried vet, they've since gotten married and they want to put their spouse on the loan, that's fine. They can do that and do a streamline. If it's an unmarried vet on the previous loan, and let's say, for example, then the veteran passes away. The spouse wants to do a streamline. Can't do it. So use this chart to determine what can and cannot, and who can and cannot go on the loan. All right, what else? You guys had enough? Well, there's a few other just little odds and ends that I want to point out. First of all, the VA loan, in most cases, is going to be an owner-occupied property. All purchases have to be owner-occupied. If you have a streamline, there may be exceptions, but I will say in general, this is an owner-occupied property. No investment or second-home purchases. A lot of times the VA, I think the general perception may be that it is a first-time home buyer product. It's not. VA borrowers can own other properties as long as the subject will be owner-occupied. Non-occupant co-borrowers, unlike your FHA deal, can't put them on to qualify. Can't use non-traditional credit. We mentioned earlier that loans may be manually underwritten if we get a DU or LP refer, but the loan still meets guidelines for manual underwriting. There are no spot approvals for a condo. Condos must be on VA's approved list. And I included the handy link here for the condo PUD builder. And I just have to tell you right now, if you're looking up one of these condos, you might get a little frustrated sometimes. So I would recommend having a copy of the legal description close by. Reason being is, when they set up these condos, they put them under some funky things. For example, in the city of Escondido down here, most projects on the VA list are listed under a tract number. So if you plug in the condo name, the project name, and nothing comes up, keep trying. Try something else. Try a tract number. Try a map number, and you may just be surprised at what you can find. Termite report and clearance is required on existing properties in areas where the IRC, the International Real Estate Code, I think I have my acronym correct there, has been deemed as being in a very heavy or moderate to heavy infestation zone. And you can see the map on the right here. Yeah, lucky those of us pretty much in the entire south shaded portion are in one of those zones. So in that case, termite reporting clearance would be required on all VA loans. We also have to have clear cavers. Remember, cavers is looking for government defaults. VA, for some strange reason, doesn't want to guarantee a loan where the borrower, previously defaulted the government. Strange. And then also, a joint loan is allowed. And when we're talking about a joint loan, we're talking about a property that is held by a veteran and another person other than the veteran's spouse. Now, there's a couple little caveats here. First is that we have to send those loans to the VA for prior approval. And then also the VA is only going to guarantee the veteran's portion of the loan, or the veteran's half of the loan. And because of that, we're going to require a down payment of some sort. There's no set guideline for that, but there will be a down payment required. All right, so we've ran over most of the little underwriting basics, the 101 version. So now we're going to talk about, for those of you that need to get in the system and order eligibility. So on all VA loans, we want to make sure that the person we're giving the loan to is eligible for financing. And we want to make sure that they have the proper entitlement to allow them to do a VA loan without putting any money down. The nice thing is, those of you that have done VA loans in the past, you probably remember sending your veterans to the local VA office with that green request form, or with the request form to get that green piece back. Well, the good news is that it's all done online now. Most everybody can get their certificate of eligibility with just a few clicks. And that's all done through the VA's VIP, or Veterans Information Portal. Now, within the VIP, those of you who maybe have used the system before but haven't for a while, they used to have all the different things that you could do within the VA system and on different screens, and it was kind of tough to navigate through. Most of what we have to do for loan guarantee purposes is all done within one screen, which is the Web LGY. So you're first going to want to log in. Hopefully everybody has their usernames and passwords. If you need instructions on how to do that, it's pretty simple, but let me know. So once you've logged in, you're going to see over on the left-hand side all your services and applications. You'll click on Web LGY. On the next screen, you're going to see a portion, I think there's 3 columns that come up, and it's the middle column where it says Eligibility Links. And you'll click on Automated Certificate of Eligibility. And then the next screen that pops up is your data entry screen. And on the next few slides, I do have to mention too, I would love to do live demos on this stuff, but VA gets a little funny about putting in bogus borrowers into their system. So unfortunately, we're going to have to do this via screenshots as opposed to actually going in and working with the system live. Oh, weird, huh? But you can see on this next screen, just very simple, the veteran's name, social, have to put it in twice for good measure, date of birth, don't have to put in service number, but you certainly can, and then whether they're previous VA loans, yes or no. You click submit, and in most cases, you're going to get the certificate of eligibility returned. There are certain instances where it's not going to return anything automatically, and so you have a couple different options. In some cases, you can upload their DD-214, which is their discharge notice or discharge papers, and the 1880, which is the request for certificate of eligibility. And after a little bit of research, they will be able to return a certificate electronically. If that doesn't work, let's say, for example, I believe that this applies to surviving spouses, if I'm not mistaken, you may have to go old school and mail it to the VA or take it in if you're fortunate enough to be close to a VA office. But I would say that those instances now are very far and few between, thankfully. So when the certificate is returned back, this is what it's going to look like. The names and numbers have been changed to protect the innocent, but it's going to give you their reference number, the name of the veteran, last 4 digits of the social. We won't go into entitlement codes, but they mean something. And then the branch of service that they served in. This middle section here, if there were any prior loans charged their entitlement, those are going to be in there. And then down below, you're going to see what their basic entitlement is. So you see, in this case, this veteran's basic entitlement is $36,000. That is, for all intents and purposes, full entitlement. Someone way down the line years ago, back when the max VA loan was $144,000, they came up with this 25% figure of $144,000 for $36,000, and that was going to be the borrower's basic entitlement. Now, I will say that up to county limits, they will still go above and beyond and still guarantee 25%. Now, if they do not have full entitlement on this certificate of eligibility, they have to either pay off their prior VA loan in full and or dispose of the property, or the prior VA loan had to have been assumed by a veteran who substituted his or her entitlement. If they don't have that full entitlement restored, doesn't necessarily mean we can't do the loan, but there's going to be a down payment required. Now, there is a one-time, and this is literally once-in-a-lifetime shot at a veteran getting a restoration if they have repaid the prior VA loan, but they still have the property. And that's a one-time thing. Another important thing that I want to point out is on a divorced borrower, if the spouse was awarded the property, but the spouse hasn't refied, or if they're not also a veteran, or pay off the loan in some other way, entitlement cannot be restored. That could be a little tricky. All right, so that's the basics of the certificate of eligibility. I swear we're getting into the home stretch here. For those of you that have to order case numbers and appraisals, let's go over that process. First thing I want to mention is that case numbers follow the property, not the veteran. So let's say, for example, veteran is going to purchase one piece of property, that falls out, they select another, a new case number has to be ordered. If there are any lender transfers of the case number, those of you who have experience with FHA, it works a little bit differently, and it's kind of a pain. You know, on FHA, you can do everything electronically now. VA, everything is still done between the lender via written assignment letters, and then the new lender. So let's assume we have one assigned into us. We would contact the VA to have that case switched into our name. And then when we go to insure the loan, we're going to have all the documentation, going from one lender to another. All right, so to order the case number, we are again going to get into the VIPs, or the Veterans Information Portal website. And there's a little screenshot of the sign-in, username and password. Click the arrow. Once you're in there, you're going to go to the WebLGY portal again. That will open up in a new window. And from this screen, you're going to have a couple of different options that you can click on. You can click on this loan drop-down menu and click on Request Appraisal, or over here on this side where it says Obtain New VA Loan Number, or LIN, you can click on the Request Appraisal from there. It's going to take you to the exact same place. If you're ordering a streamline, this is very important. Click this link up here, Order Earl. Now remember what I was saying about how we don't want a VA appraisal to be sent to the VA and logged into their system on an Earl. That's why we get a conventional appraisal. So if you click on this Order Earl, it's not going to assign an appraiser just a loan number or case number. All right, so the next screen, this is another very important thing that I need to point out. For the time being, we need to order all appraisals as IND cases, or individual certificate of reasonable value. That is because we do not have LAP designation yet for our underwriters. And LAP is basically that's Lender Appraisal Processing Program, which gives our underwriters the ability to underwrite and issue a notice of value on an appraisal. As of right now, we don't have that, so all NOVs are going to come from the VA. Kind of the quickie process is that we'll request the appraisal with the appraiser that's assigned. The appraiser will upload that appraisal into VA's portal, and they have up to 10 business days to perform that appraisal. And then the VA will need to issue the notice of value. And the VA has, or any underwriter has, up to 5 days to issue the NOV after the completion of the appraisal. So I'm not saying that it will take that long, but I do want to let everybody know that the good thing is that there are some sort of guarantees or commitments that need to be made on the timing of both the appraisal and the NOV. All right, so anyway, so we're going to select an IND case, and we're going to click Submit. And then again, I'm sorry, all I have is a screenshot, and I couldn't even include the whole screen, so I just put a little portion of it here. But you're going to just go through the next screen, all pretty self-explanatory, and complete all applicable information. Now you're going to see on the screenshot here that there's some red asterisks. Those are mandatory fields. That's all you need to do to get a case number. But keep in mind that, the rest of the information is there for a reason. It makes the appraiser's job a heck of a lot easier if they have, all the other stuff, where to get the keys and all that good stuff at hand. All right. If the property is a condo, and that's not on the screen, but you're going to see a little link to open up that Condo PUD Builder where you can look up the project approval. And then the screenshot that I do have on here is the property address portion. So you'll see we have our property address in there, and then there's a button that says Verify Property Address. If you click on that button, it's going to check that against USPS records to make sure that we have our address entered correctly. So you'll continue entering everything, and then once you get down to the bottom, you're going to see a little checkbox above the Submit button where it says Acceptance of Responsibility. And you basically have to click that box to sign your life away and get your case number. All right, so once you click Submit, that is going to generate a request for appraisal, aka the 1805. Again, because I couldn't make a dummy loan, I just took a sample, just a little screenshot here. You'll see in the upper left-hand corner, box 1 is our case number, and these first prefixes here are going to be based on the VA region code, and then that's 6, which I'm sure means something. And then the numbers that follow, which have been whited out in this case, but those are the remaining numbers of your case number. Down at the bottom of the form, you're going to see the appraiser contact information. VA was, well ahead of the curve from all this other appraiser independence garbage, in that, they've been working with a fee panel for many, many years, and most of the appraisers on that panel have been on their list for 150 years. So you'll find that they're kind of a breed of their own in some cases. But anyway, so you don't have a choice in this case. You're going to have an appraiser automatically assigned by the VA, and you will contact that appraiser in order to perform the report. From there, like I said, everything's kind of done electronically, so it's a heck of a lot easier than it was in days of yore. One other step, after the case number has been ordered, then you want to go back into the case and upload the purchase contract. And you can find a loan. Now you have three options. You can either go into your loan drop-down box, loan inquiry, and then enter your LIN, or loan identification number. You can go to this section here under loan inquiry. Oh, didn't mean to do that. Sorry. And click on enter LIN, or there's even a handy box for you. Enter in your LIN. So when you're entering that case number, make sure to put in the whole thing, including your prefixes, your dashes, etc. And then you'll click submit. Okay, so this is what it looks like after you have found your loan. You're going to see two things, your correspondence, which is what we're going to use to upload the purchase contract, and then you'll also see you have status on here. So in the case of this example loan, this case number was ordered and purchase contract was uploaded on November 15th and is currently out for appraisal. All right, so for correspondence on this case, we'll click on the correspondence button. It'll bring up this little screen here where you enter in your submission date, document association, what type of document it is, and then you'll browse for that file on your hard drive. Just click the browse button, find your purchase contract, and click upload. And then it's also important to know how to get into this screen, find your loan, because you'll also be able to pull your NOV and stuff like that, the appraisal, from this portal as well. All right, we're almost there. See, I allotted an hour and a half, and we're going to make it. I want to point out some specific VA forms and disclosures that we may or may not have talked about throughout the course. And this is going to be a lot more useful to you when you actually have this presentation in hand, because I've included live links. So I won't go through every form in depth, but they are here for you. Just a couple I want to point out. A lot of these will also print out with our initial disclosure packet. All right, let's go down here towards the bottom, the Alive and Well certification. You may have borrowers that are currently in active duty, they're deployed, and they're signing with power of attorney. Well, it's kind of important for us to know that our borrower is still alive and well. So we're going to want to see a letter from the commanding officer just basically stating that our borrower is A-OK. The nearest living relative statement, there's going to be a form that prints out with our initial disclosure packet. On all VA loans, we just want to know the information of the nearest living blood relative to the veteran. Why VA hasn't made some sort of standard form for that, I don't know, but it's not. But it will print out with our disclosure set. The VA escape clause. One cool thing about the VA, remember, they're very into helping the borrower out. They have this escape clause. If there has not been an appraisal and notification of value or notice of value made on the property before they sign that purchase contract, which I don't know why there ever would be, the veteran can get out of the transaction without penalty if the value comes in low. Kind of a neat little clause, so they can't be on the hook for anything. The other thing I want to note is, we had our disclosure training today, and we talked about click signing or e-signing disclosures. Keep in mind that that is only on conventional loans, does not apply to FHA, VA, or any other loan type. So no e-sign. All right, just to run over, you guys are probably experts on all the lingo now with Chuck Woolery, but just included a few definitions here that you can refer back to at a later time. Yeah, we talked about VA. We didn't really talk about SAR, or Staff Appraisal Reviewer. And that's basically the underwriter for a LAP. It's kind of a LAP underwriter. It is somebody within the company that has the ability to review an appraisal and issue a notice of value. Speaking of which, NOV, that's our notice of value. LAP, the Lender Appraisal Processing Program, which gives us delegated authority to have our SAR issue an NOV. See, love those acronyms. We talked about EARL. Didn't really talk about a VA no-no. We talked about how, of course, borrower doesn't have to put any down payment, and the seller can pick up any and all closing costs, hence the term VA no-no. No down payment, no closing costs. If you ever see VAFF, that's VA funding fee. Our DD 214 is our certificate of release or discharge. 1805, we just went over that for our appraisal request. COE, certificate of eligibility, and our LIN, loan identification number. Now you should be able to speak VA. And finally, have a few handy links that, again, once you have this presentation, you'll just be able to click on those and be taken to the appropriate section. So I recommend checking all of these out and familiarizing yourself with the systems. And like I said, again, I will send over the presentation as well as our investor guidelines, and then I'll also send over a list from DocMagic of all the VA proprietary forms and disclosures that print out with our packets. Other than that, the rollout is Monday. Yolanda's back, and she's got her VA hat on, and I think Ellen already has one that's waiting in the hopper to underwrite. So, we're ready to get started with this, and it's an exciting new offering for us. There will be marketing. I'm finishing up some marketing materials that they need to go through the channels of being approved by compliance, but those will be out as soon as possible. And then, as far as everything being into Price My Loan or iPrice or whatever you want to call it, that is all in process as well. So, Monday, the goal is we're going to be ready to roll and take in all your VA loans. So I thank everybody for your attendance. I'm going to go ahead and stop the recording. This is going to be fun to listen back to someday, I would imagine, maybe, if you have another hour and a half to kill. And then anybody that wants to stay on, I'm going to go through any questions that have been posed. And Ellen, are you going to stick around for a few minutes just in case there's any gnarly underwriting questions? Yeah. Okay, perfect. And those of you that need to jump off, feel free to, and I appreciate your time.